Now, the investment route you're traveling is a good one, because the stock has paid satisfactory dividends.
This absolute unit of a book was written by Benjamin Graham, the father of value investing, the guy that Warren Buffett cites himself as his biggest influence.
And then finally I read Graham's book.
Ben Graham.
Making money did not motivate him.
Only paper Ben was chasing was trees to make this thing. But right in the middle of this book is a line that is relevant to today's conversation. The prime purpose of a business is to pay dividends to its owners. A successful company is one that can pay dividends regularly and presumably increase the rate as time goes on. Back in the day, dividends were why investors bought businesses. They wanted that income. But, take a look around today and it feels like dividends have hit a dead end.
Dividends do not matter.
Okay. But in 2023, companies in the S&P 500, so that's the 500 biggest listed companies in America, paid out around $588 billion in dividends to shareholders. That's more than $500 billion. Since 1926, dividend income has made up 31% of the total returns of the S&P 500. How can that money not matter?
When you do things like buybacks and dividends, what you are essentially saying is, I do not know what to do with this money.
The negative sentiment towards dividends started right here in this academic paper. I forgot to take out the coloured paper that I put in for the last video for the questions. And yeah, it printed out on that, so that's why it looks like this. I'm not reprinting the thing. Money doesn't grow on trees. Well, unless you're Ben Graham, that is. This is a 1961 paper from the Journal of Business, where these two guys put forward the arguments as to why dividends don't matter. I'm just going to keep this real simple at this stage. The basic argument is that you're just moving money from one pocket to another. Let's say that I'm the company you're invested in, and I've made £10. I give you £1 of that as a dividend. How much money is there? There's still a total of £10. But now, as a company, I'm down to £9, which means I have less money, which means I'm worth less now. This is the idea that when a company pays a dividend, their value drops by the same amount to accommodate for this. Secondly, I've now lost the ability to use or reinvest that money to generate a return. The business can't reinvest that money to make more money. And the argument is that investors should want that to happen because, what's best for the business is best for the investor. That is a heavy oversimplification of dividend irrelevance theory, as it's called.
Dividends do not matter.
Now, we can sit here and debate the merits of dividends, the fact it gives investors the ability to decide where they allocate their slice of the profits, or that it's dependable income. And we can discuss the drawbacks. You're just moving money around. The business clearly has no good ideas for growth if that's what it does with its money. Dividend payouts can be easily manipulated, and not to mention the tax implications, which can be good or bad. But let's just stop for a second. This is a debate that's gone back and forth now for 60 years. The dividend enigma has not only been an enduring issue in finance, it also remains unresolved. Besides asking ChatGPT what it thinks, we're probably not going to solve this today. But what if there's another way to look at this? What if for most investors, you included, at a point in your life, dividends are very relevant? Before we look at that, let's take a look at another thing that will be relevant to a lot of us at some point in our lives. Today's video sponsor, Manual. I was concerned about the dwindling growth of my hair, and I've been using Manual services now for over 12 months, and that consistent effort has been paying dividends. My hair started thinning when I hit my 30s, which is pretty natural, but not something I was really willing to accept. I know hair transplants are a thing, but I wanted to try other methods first. Research led me to academic papers around minoxidil and its effects, and this then ultimately led me to Manual, who provide clinically proven treatments direct to your door with no need for an appointment. It's really simple. All you have to do is just go onto their site, fill out a questionnaire, and then that's it. I'll leave a link below to their services so you can check them out if you want to. And if you use code DTM55 at checkout, you'll get 55% off your first order. You can also cancel anytime. There's no subscription periods or anything like that. Right, let's get back on with the video. This right here is a breakdown by sector of one of the most successful indexes on the planet, the S&P 500. Each section is how many companies on that list of the 500 companies does a certain thing. 10% are healthcare as an example. This pie chart is still compiled from the S&P 500, but it's specifically companies within that list of 500 businesses that have a track record of increasing the dividends they pay each year for at least 25 years. Every year for at least 25 years, they've increased their dividend, so they're part of this club. Some of the companies do it by a tiny amount just to maintain that status. Like I said, easily manipulated. But anyway, 66 companies out of the S&P 500 make up this pie chart. This is the so-called dividend aristocrats. So what we have is a representation of the most successful market on the planet in the S&P 500, and then the most successful dividend companies, or at least the biggest. just as a point of comparison. Comparing the two side by side, there is a key difference. It's this difference that gives us an insight into why in recent times the dividend approach has faded in popularity. Can you see it? I mean, you're surrounded by it.
They'll want all the benefits of modern technology.
Tech businesses favour growth over dividends, reinvestment over distribution. They take the money they earn and they plough it back into their businesses because they're seen as high growth companies where that's worth doing. Dividend payers typically are associated with more traditional sectors, larger, more well-established businesses where there's less room for explosive growth. So they give the profits to the investors. For this reason, the aristocrats are almost completely void of tech businesses. This thin purple-pink line here. And what we see is a large presence of more traditional sectors. In the future, the tech businesses of today will likely become the dividend payers of tomorrow. But up until now, that hasn't been the case. As tech has dominated, a dividend investment approach has fallen behind. But really, that's quite a recent phenomenon. Take a look at this chart. It tracks the total return, so that means with everything included, dividends reinvested and all that, of both the S&P 500 and these dividend aristocrats. You'll notice that they tracked each other very closely. In fact, the aristocrats outperformed slightly until post-COVID, where tech has exploded and since pulled away. It feels like yesterday, doesn't it? But it was 4 years ago now. And humans have this predisposition towards recency bias. Managers tend to judge employees on the work from the last few weeks when doing annual performance reviews. Sports fans think that because a team has been successful in the past, that should continue. Your average United fan's still trying to come to terms with that one. With investing, we tend to think that the themes that have happened recently will continue. They might, they probably will. But what happens if they don't? What happens if tech doesn't dominate? What happens if tech goes backwards? The 90s was a period of tech exuberance. The internet was a shiny new idea that was set to revolutionise the world we lived in, with the promise of rapid productivity growth.
Allison, can you explain what internet is?
The long boom, as Wired magazine called it in 1997. The internet was going to change everything, and anyone involved in it would get rich. I mean, does that sound familiar at all?
Artificial intelligence, both the opportunities it presents and the dangers it poses.
Roy Amara once said, "We overestimate the impact of technology in the short term and underestimate the effect in the long run." In a way, the predictions were right about the internet. It would change everything. The problem was the party just got started a bit too soon. The bubble burst March 2000. And NASDAQ, which is a list of companies that is very tech-heavy, fell from 5,048 to 1,139, erasing almost all of the gains produced by the mania of the previous few years. It would take that index and the tech industry years to recover. Such was the bad taste left in investors' mouths that they didn't trust any tech business that came along, even really good businesses. Google, one of the most successful companies on the planet today, struggled to get to market in 2004.
I absolutely think there could have been a time and a place where the IPO would have performed better.
Because investors remembered the pain of previous search engine investments.
Do you, Yahoo?
Another form of recency bias. The collapse in tech was acute and drawn out, and it wasn't that long ago. I'm going to show my age here. But Destiny's Child, NSYNC, Macy Gray, Aaliyah all had hits at this time. And as tech speculators dusted themselves off ready to try again, one category of investor navigated this period pretty unscathed. You guessed it, dividends. In the recessionary period from April 2001 to November 2001, the S&P 500 as a whole produced a negative return of 0.78% annualized. The aristocrats, though, put up a positive return of 28.86%. Then, during the recovery period, which was from 2001 to 2007, the S&P averaged 8.2%, the aristocrats 13.2%. Across the 20-year period this study looks at, from 1990 to 2010, the aristocrats outperformed the total index. That's a 20-year period of significant outperformance from the dividend-focused component of the index. The presence of large crashes across this time period helped. This is a 2023 study into the importance of dividends, and Exhibit 9A looks at the performance of the aristocrats versus the overall index in good and bad times. In months where the S&P 500 is rising, the overall index beats the aristocrats in around 56% of months. But in down months, the aristocrats tend to perform better. They crash less, around 69% of the time, they beat the S&P 500 in a downturn. First of all, markets tend to go up more than they go down. So the fact that in good months, the S&P 500 overall tends to do better is important, especially for those of us with long investing timelines. But what about when you don't have decades in front of you? There are two very distinct periods in an investor's life. The part where you're building your pot, let's call this the accumulation stage, and then the part where you're spending your pot, let's call this decumulation. In the accumulation phase, investors want to get as much money as possible. They care about growth and building the pot. For that reason, and on the understanding that markets go up more than they go down, exposure to the whole index, according to studies like this, makes sense more than it doesn't. But in the decumulation phase, the opposite is true. The investor has their money and they become more concerned about protecting it and making sure that it lasts. The worst thing that could happen in a decumulation phase is a market crash that takes with it 30, 40, 50% of your portfolio just as you're about to retire. This is called sequencing risk. It's the danger that your retirement pot is exposed to the worst market conditions or returns at the worst possible time. I'll give you a visual example using this chart. Let's say that you need £30,000 a year in retirement to survive, and no matter what the market does, you have to take that out of your portfolio each year. The blue line is the ideal but will never happen example, almost the control, where market returns are even and every year you take out 30k, but the market produces 30k in gains. So the value of your pot stays the same over the time period. That's why the line's flat. Everything you take out is replaced by growth in the market. The orange line here is where there is a crash, but not until near the end of your life, where the orange line declines steeply here. So the pot actually grows as you live off it, but then the crash here sees a significant fall in the value. But it's okay, as this growth here still means that you have a decent chunk, more than you started with. Now the green line is the worst case scenario, where a crash occurs early on, and that means that your pot never recovers. The early decline here means that you have significantly less to live off for the rest of your retirement because you kicked the portfolio so hard at the start, and then there's not enough in it to ever recover when the markets do. Each of these examples starts with the same amount of money, but the position of the crash, the sequence it happens in, changes the outlook of your retirement significantly. That is the sequencing risk. So at the point of pre or in your early retirement, you care more about that risk to the downside than you do about maximizing upside potential. I recently interviewed an economist on my podcast and she said this about crashes.
So of the 10 great crashes I write about, half of them happened in this century. I mean, now that's depressing.
Yeah. For that reason, a dividend approach, like the one you get with the Aristocrats, could be more attractive because you're still getting that stock market exposure and producing gains long term, but also you now know your portfolio is a little bit more durable in times of a crisis, which since the turn of the century have become more and more common. At my age, I'm not concerned about volatility because I've got decades in front of me, but at some point that becomes the biggest concern and focus of all investors. Risk-adjusted returns is a measure of an investment's performance versus the risk it takes to get there. In a simple example, let's say you wanted to drive from point A to point B and you have two cars to choose from. Car number one is a sports car. It can drive very quickly, but the ride is uncomfortable, especially at top speeds. You feel every bump, you get flung all over the place. Car number two is a slower car, but the ride is much more pleasant. You might opt for car two with the lower total speed for that more comfortable ride. The Dividend Aristocrats have historically produced a higher risk-adjusted return than the S&P 500. That doesn't mean that the total return has been better. What it means is, relative to the risk taken, to how bumpy the ride has been, the Aristocrats have got you to your destination easier. Meanwhile, the S&P 500 might have got you there faster, but the ride was much bumpier along the way. Dividend irrelevance theory often focuses on the idea that you shouldn't buy a company solely because it pays a dividend. That it doesn't really matter all that much, and just picking up a business because it pays one is a bad idea.
Dividends do not matter.
Clearly, that's not proper securities analysis, is it? But in the same way, I could say that buying a business by going, electric cars or AI are the future, that's also an oversimplified, poor way of assessing if a business is a good investment or not. I mean, imagine if this beast called securities analysis went, forget actually valuing the business in any way, shape or form. Just buy into companies where you like the product or you think there's a long-term trend that will flip the world on its head, even if you don't really know much about that long-term trend, it's just that your mate told you it was going to be a big deal. Or if they pay a dividend. Any dividend. One page, millions of trees' lives saved, simple as that. Instead, this thing is 851 pages. I think this is a clear visual representation of the sort of work investors need to be doing when when actually buying individual companies, dividends, growth, whatever. Because there are plenty of examples of companies in both schools of thought that have produced exceptional returns for investors, but 99.9% of people aren't good at picking those companies. So when we talk about dividend irrelevance, I'm going to stop waving this thing around, it's like a brick. What I'm interested in, and what this channel aims to do, is answer how should us normal folk think about it? How should people act around this topic that want to benefit from investing but don't want to have to sit there and digest and put into work books like this? Let's zoom out, shall we, and focus on the wood and not the trees, if you will. The fact is, markets go through cycles, and the needs of investors change over time. If you're at a point in your investing timeline where a downturn would be devastating, I bet you would find the fact that the dividend-focused component of the S&P 500 has produced better risk-adjusted returns and have performed better than the overall index in recent crashes very relevant information indeed. The research around the strength of the Aristocrats and their ability to significantly outperform the overall index for decades in recent history, it really surprised me. But I won't change my investing approach. I'm in the accumulation phase. Give me the keys to the Lambo so I can stick my foot down and ride it out, bumps and all. Because I know markets go up more than they go down, and in that scenario, the whole index tends to outperform. But there will be a time when that attitude changes. And now I know, as well as cash and bonds or any other form of de-risking, a broad, diversified portfolio invested in large companies like the Aristocrats is another option in retirement for protecting against things like sequencing risk, whilst also providing a potentially tax-efficient income along the way. Do what you will with that information. I'm off now to try and process the fact that NSYNC were a big band nearly a quarter of a century ago. Yeah, see you soon. Ba 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 ba.